In 2025, gold remains the paradox of the investment world, both a safe haven and a speculative gamble. With bullion hovering near $2,350 per ounce, gold prices have defied expectations amid persistent inflation, geopolitical tension, and central bank buying. Yet for investors eyeing gold mining companies, the story is more nuanced. Profit margins are tightening, exploration budgets are shifting, and the next bull cycle may favor disciplined operators over dreamers. Major asset managers such as BlackRock, VanEck, and Sprott have all reported renewed inflows into gold mining ETFs in Q3 2025. The VanEck Gold Miners ETF, GDX, rose nearly 14% year-to-date, outperforming broader equity indices. But the enthusiasm isn't uniform. Investors are rewarding balance sheets, not promises, says portfolio strategist Elena Cruz of RBC Capital Markets. Gold mining investment today is about efficiency and jurisdictional stability. In practice, that means the market is tilting toward established producers like Newmont Corporation, Barrick Gold, and Agnico Eagle Mines, all of which have maintained dividend discipline even as costs rise. Emerging markets, by contrast, are seeing capital flight amid political volatility and environmental protests. The industry's all-in sustaining cost, AISC, a key profitability metric, has climbed to an average of $1,450 per ounce, up 12% from 2023 according to S&P Global Market Intelligence. Energy, equipment, and labor inflation remain persistent issues, especially in Africa and Latin America. For investors, that means smaller miners with sub-$1,300 AISC operations are increasingly rare, and highly valued Australia's Northern Star Resources and Canada's Alamos Gold have become investor favorites due to lean operations and robust free cash flow. Meanwhile, juniors in West Africa and the Andes are being squeezed by local taxes, unstable currencies, and higher diesel costs. Exploration spending reached $7.9 billion globally in 2024, up 8% year over year, yet most of that money is flowing into brownfield extensions rather than risky greenfield projects. Environmental, social, and governance ESG criteria now dictate capital access, a shift that has reshaped deal structures and valuations. Gold miners that can demonstrate carbon-neutral processing, dry stack tailings, and community equity models are securing premium valuations. Companies such as B2Gold in Mali and Yamana Gold in Argentina are using solar-powered milling and water recycling plants to attract institutional ESG funds. Skillings analysis. Investors aren't chasing ounces anymore, and they're chasing resilience, says Skillings analyst Charles Pitts. The future of gold mining investment lies in operational integrity and jurisdictional credibility, not speculative drilling. For 2025, the sweet spot is mid-tier producers with 10 to 15-year mine life, low debt, and exposure to US, Canadian, or Australian jurisdictions. These firms are the backbone of the next sustainable gold cycle. With valuations stabilizing, M&A activity is poised to accelerate. Analysts expect a wave of mid-tier consolidation as firms seek scale to manage costs and hedge volatility. Barrick's rumored interest in West African assets and Newmont's streamlining of its Nevada operations signal a reshaping of global portfolios. For retail investors, gold mining stocks remain a leverage play on the metal, but with higher risk, experts suggest focusing on royalty and streaming companies like Franco-Nevada and Wheaton Precious Metals, which offer gold exposure without direct mining costs.